Welcome to The Pitch. I'm Hunsley from Livewire Markets. And if there's anything that gets a stock market bear going, chances are it's the subject of concentration. Because the 10 largest US stocks now account for 33% of the S&P 500 index's market value. That's well above the 27% share reached at the peak of the tech bubble in 2000. But is that necessarily a bad thing? Let's discuss with Chris Smith, portfolio manager at Intermede Investment Partners, joining us out here from New York. Chris, great to have you with us.
Yeah, thank you for having me.
So I mentioned there are so many superlatives being used in global equity markets now. Well, I just mentioned the Magnificent Seven, or that top 10 in the US, right? There's the Seven Samurai in Japan, there's the granolas in Europe. Does all this concentration and the hype around the concentration worry you?
It is a different era, I would say. The Magnificent Seven are making up a larger and larger portion of the market. When we started out 10 years ago, there wasn't a security in the market that was more than 2% of the benchmark. Now we have several that are close to 5%. It has changed the way we manage the portfolio to some extent. I think when you look at that Magnificent Seven group, most of them are really delivering. So it is justified, the moves that they've had in stock price. You have earnings growth going mid-teens or better for most of them, some well into the 20s. You have revenue growth well into double digits for most of them. And you have multiples on some of these stocks that are below market average, less than 20 times on Meta, less than 20 times on Alphabet. So there's still pretty good value across the space, and so we do invest in quite a number of them.
Does this new paradigm that you talk about, does it alter the way you perceive them then as investment opportunities?
Well, it does make it very critical that you have a view on all of these companies, and certainly missing out on one of them that's doing quite well can be very painful as a manager. And there's a couple examples which we might talk about. Nvidia is one of them that we didn't have last year. So you do have to be very aware of these key names, and you have to have a view.
If I think about what we're kind of going through, like the day that we're taping this, we're still in the thick of the US earnings season. We've just been through the banks. We're in the middle of tech. Yeah. Consumers not that far away. From a thematic standpoint, what's been the most interesting takeaway from maybe the recent US earnings season so far?
I think the tech earnings have been interesting. You've seen revenue growth going quite well. You've seen an increasing contribution from AI. So there's a lot of concern about all this capital going in. What kind of contribution are we getting? I think Microsoft demonstrated that a lot of their Azure growth is actually coming from AI. So they're seeing a good boost from that. Amazon as well is seeing some good uptick from AI. You saw an increase in AWS growth, the cloud part of the business that they just reported very recently. That's partly driven by AI, and I think it's pretty amazing. But you've seen CapEx budgets that are already expected to be growing very significantly this year were pushed even higher for some of the big companies like Microsoft, like Alphabet. More than 50% growth year over year off already quite high levels. A lot of that's going to AI. So that's the sort of thing we've been following. Meta was the one that was viewed as a disappointment last week. So they had been having this year of efficiency that's given them a lot of benefits. You saw a lot of margin expansion. Now they're investing again, and this time in AI. Hopefully that turns out into something. It is the name that we have in the portfolio.
Yeah, no, absolutely. Let's kind of come to that because you've already alluded to it a little bit. 4 of the Magnificent Seven, I think this is really interesting, everybody. 4 of the Magnificent Seven are in the fund's top 10 positions, but there's one that I really want to talk about, and it's actually a recent addition, and it's Nvidia. Nvidia reports within the next couple of weeks from, again, the day that we're filming this. It's kind of late May. So I'm curious, with Nvidia being a recent addition, why are you buying now, especially after the unprecedented run that it's already had?
Yeah, so it is a bit painful to buy a stock that's up that much, no question about that. But the more we thought about it, the more we felt comfortable with the fact that it's more than just a hardware company making a fast chip at the moment. There's a whole ecosystem around that, and barriers to entry in this space we think are quite high. And the growth can be sustained, as we saw, as I mentioned this week, we've seen CapEx budgets being increased on top of increases from a couple months ago. That money is flowing to Nvidia. So we had been behind the curve, I would say, on estimating the potential for this business. We decided to go with our upside case on the stock rather than our base case. And on that basis, we had 20% plus upside, which is what we look for to enter a name. We are still below benchmark weight, so being a little bit conservative on that, but it is one of our favorite names in the sector, and we felt we couldn't keep betting against it and effectively being short the stock.
And just finally, so we talked about 4 of the Magnificent 7. I'm curious about the other 2 that I didn't see kind of in that top 10 of the documentation. Alphabet's there, Meta's there, Amazon's there. There's 2 others, of course, of that famous acronym, Apple and Tesla. Do you own the other 2? And if not, why not? Or if you do, then why?
Yeah, so Apple we've had for many of the years that we've been going. We have been out of it recently, given, this is for the past couple years, given valuation. So the services growth in that business wasn't being reflected in the price we thought at one time. Now it's being fully reflected. iPhone sales have been pretty soft, so it's quite a penetrated market. People have delayed the upgrade cycle relative to what it was. So you've seen declines in iPhone sales, and that's really the driver of the business at the end of the day. I would say at this point we do feel exposed by not having that in the portfolio. So we're effectively short 4% of Apple. There's a possibility with their next round of phone launches that they could talk more about the AI capabilities. I think that's what's been missing from the story. Tesla is one where we've never owned, and we have a number of concerns about the long-term competitive position of that business. So they were a first mover in EVs, but there are a lot of other car companies out there and a lot of capital going to develop new models and new platforms. And we feel that over time, they're not going to be able to make the kind of margins that they were making. We've seen that play out a little bit, I would say, recently. We've also seen the EV market slowing, maybe more than expected, not taking off quite as much, particularly in the US. So a number of reasons why it's not been performing. But for us, it really comes down to just, is one company really going to dominate a market with just a few models of vehicles? And we don't think so.
Chris, this has been really insightful. Thanks for joining us.
Yeah, thank you.
And thank you for joining us for The Pitch. If you enjoyed that interview, you can go to livewiremarkets.com where you can see more episodes of The Pitch and subscribe to our YouTube channel as well. Thanks for watching.